Yeah, man.
We'll have lyrics to this one day.
Heck yeah. All right. Welcome back to another exciting episode of the I Love Annuities podcast. I'm Jeremiah Conger.
And I am Zachary Van Ness, and together we are
the Annuity Dudes.
Welcome
Today
back.
We're diving deep into the actual anatomy of an annuity contract. Not the sales brochure, none of the fancy marketing fluff, just simply the facts of understanding once your annuity is issued, what you should be observing in that annuity contract to determine whether or not that annuity was issued as applied for, or if you should, free look that policy and get the right one in your possession.
Yeah, so really today what we're going to cover is just talking about the fine print, right? So the legal guarantees, the riders, the fees, surrender schedule, everything that really matters. And when you're locking in a lifetime of income or protecting that retirement egg, really what we want to do is focus in on what these contracts can do, where these guarantees are, and where the non-guaranteed elements are.
Did you just say retirement egg?
I did. I tried to just breeze right past it too.
Retirement egg. No one heard that. Don't worry. Retirement nest egg, I think, is what he meant. But I like retirement egg. I think that's good. And eggs are valuable these days, so you definitely don't want to crack
them. They're coming back down.
Yeah, exactly. So whether you're investing for protected growth or guaranteed income for life, you ultimately need to understand exactly what's in the contract that you've put your hard-earned money inside of.
Yeah, so we would jump right into it and just ask, really, first things first, what exactly is an annuity contract? And when we look at that, it is a legal agreement between you and the insurance company, right? So that you give them the premium, either a lump sum or a series of payments, and they promise or guarantee a certain benefits in return, like a lifetime of income, principal protection, maybe it's a guaranteed rate or a death benefit.
Yep. And so unlike investments that are subject to market risk, annuity contracts include guarantees backed by the issuing insurance company, which are all spelled out in writing. I mean, ultimately, that's why people purchase these types of products. It's because of that contractual guarantee that the insurer guarantees to withhold and uphold, I should say, not withhold, uphold. And we want to make sure that, exactly what you intended that annuity to do will actually be able to do that. And that's going to be written inside of those contracts.
Yeah. And ultimately, it's just the blueprint for how the annuity works. That's what we're looking for. We want to make sure that what the individual was advised of, the client was told would happen, is going to happen per that contractual guarantee.
Absolutely. So why don't you take us through, Zach, the key contractual components, and then I'll do throughout this area at some point here, I will be sharing my screen and going over some examples of those specimen contracts from certain annuity providers.
Yeah, sounds good. So first up, we'll look at the owner, the annuitant, and the beneficiary. So the owner controls that contract. They make the decisions and they can make withdrawals, whatever it might be. They can make decisions within that contract. The annuitant is the person whose life is used to calculate the income benefit or guaranteed return, whether that's a guaranteed rate. And the beneficiary receives any remaining benefit upon death.
Yeah, exactly. So let me go ahead and get my screen up and we'll look at the specimen contracts to show those points, where the owner, some of the stuff's common sense, but, looking at the specific layout of the ownership, so on and so forth. Let's see if I can find one that's, if I already have it set up here. Okay. So here's one from our friends at Emeritus, and this is the income rider, so it will show the covered persons here. But if we come up in the beginning of the contract is where you're going to see the policy schedule, which will contain all of the policy information, such as the policy number, the owner's legal name, the issue age of that said owner, and their gender. If it's a joint owned policy, it will have the joint ownership there as well. And then it will specifically define the annuitants, whether single or joint as well, which can be different than the actual owners. That's one thing that most people don't know is if you're using non-qualified money, the ownership and the annuitants can be different. They don't have to be the same person. So, but this is where it would all be spelled out. It will also show the policy issue date, the maturity dates, the plan type, which is according to the funds that were used, whether they be qualified or non, the initial premium that was input, and some of the information regarding if it has a fixed account, what that declared interest rate is, and how long that guaranteed rate is guaranteed for, the period of time.
Can you
Scrolling down. Yeah, go ahead.
can you give an example of a time at which the owner might be different from the annuitant?
So sometimes in certain situations, there might be, let's say, like a grandparent that wants to leave a portion of money to their grandchild. They could purchase that annuity for their grandchild and then have the grandchild listed as the annuitant, but the grandparent would maintain the ownership of the policy. The ownership is the legal rights to change and modify the policy on an ongoing basis. So if you have ownership, you can change the information on the policy, such as like the address or the beneficiaries, the index allocations, if it's an indexed annuity, so on and so forth. So those would be the circumstances where the annuitant may not match the actual owner, but that would be one case.
Yeah, I've also seen it with the trust as well. So just
That's
worth
true.
noting.
Yeah, definitely. A trust is another good call out there. Well, the trust would normally be the owner. The annuitant would be the trustees
Yep.
of the trust in most cases. All right.
Awesome.
What else, Zach?
Yeah. So next we would have, so we've covered owner, annuitant, beneficiary, and a contract and what that looks like. Next would be the premium. So most annuity contracts, as we've seen, are a single premium, meaning that we put in one lump sum up front, and then the annuity does its job with that one lump sum. That being said, there are annuity products which have a flexible premium, which allows you to contribute additional monies over time. And from there, we would have a couple different phases with that, right? So we'd have the accumulation phase that came with that premium. And that's when your money would be growing. And that's the time at which we're allowing it to do its job. And then oftentimes, not in every case, but oftentimes we see an income phase where that premium is then converted to a guarantee of lifetime income.
Yeah. So the two phases there, I think it's important to note, when you're in the deferral phase. So if you buy an indexed annuity with an income rider, the income rider is that contract that's going to stipulate how the income benefit base amount grows during the deferral phase. And inside of that income rider contract, which will show you a specimen contract example of that as well, what they refer to as the accumulation phase is actually that deferral phase. It's when that income benefit, it's normally associated with the income benefit. And that accumulation phase is when that income benefit base is growing at the guaranteed stated roll-up rate during that period of deferral. So sometimes people will buy that type of annuity leading up to the retirement date so that they can protect their asset and give it a guaranteed rate of growth with the sole purpose of income. And then once that income rider is activated and that income starts, that's what they refer to here as the income phase. And that's when you'll start receiving those regular monthly income paychecks. But either way, having an annuity structured in this manner allows retirees to grow their money safely and convert it to a predictable stream of income. Now, you're not necessarily required in that type of product to what we call annuitize the principal investment. In an indexed annuity, you're going to still maintain control over the principal account, still have the ability to earn interest based on the underlying index crediting strategies on a non-guaranteed basis. But while that income rider does start to turn on, you still have this account value that can grow on a non-guaranteed basis to maintain or sustain that account's value even after the income stream turns on.
Yeah, great points. And I think that would carry us right into taking a look at the fixed index annuities and how those policies are structured.
All right, let me get that up here. So we're looking at, we should probably show one for like if it's just for a growth play, right?
Yeah,
Is that
let's
what
do
you're referring?
that. Yeah, that'll allow us to really touch on the index crediting strategies too. As we've covered in previous episodes with the index crediting strategies, some may have what's called a participation rate, some may have a cap rate or a spread or margin. And really what we're looking for is to make sure within that policy it matches up to exactly what we had expected when we first met and agreed to the terms of this policy.
Yeah, so normally when you're going down this process of evaluating fixed indexed annuities specifically for safe growth, so you're not necessarily adding an income rider, you're more or less buying this annuity to protect your money from downside risk while still giving it favorable or fair rates of return on the index crediting strategies. Inside of that process, you're going to normally go down a path of understanding how to assess those available products. And generally, what most people or most advisors tend to kind of lean in terms of determining whether or not an indexed annuity is a viable product for your situation is they're going to use an illustration that's generally back tested, which if you've heard any of our episodes prior to this one, we're not big fans of selling by illustration. We believe that that can be misleading because what we have found in our experience working within these products and working with consumers like yourself is that sometimes these index crediting strategies can be relatively new. They haven't been around a long time and there's not a lot of real-time data on them. But these investment banks that create these index strategies, they will back test them according to the previous market return. So they have hindsight at their advantage to be able to create these methodologies of how the indexes work. And so on a back test and an illustration, it can look really attractive. Sometimes you might even see double-digit returns in those back tested scenarios. We don't believe that that's the end-all be-all way to determine whether or not an indexed annuity is good or if an index crediting strategy is good. What we prefer to look at is real-time data in addition to the back test to see how has it performed as of late. And we use the benchmarks of the stock market and the bond market and commodities market for that matter to determine is the index actually performing as it should. We also use some analytics from our forward-looking projection from some of the index experts out there that provide that analysis. But assuming that you're looking at a product and you kind of like what you see, or maybe you're working with us and we're showing you the right way to look at these contracts and these potential growth opportunities. Once we decide which one we want to move forward with, and that's a very interactive process with you. We're not telling you what to do. We're showing you how to assess the market and how to make a good decision. Generally, you're going to have a few different index crediting options that you can choose from and how you allocate your money towards those index options. Once that contract is issued, that's where we'll verify that the indexes that we chose to allocate the funds to are actually allocated appropriately, and that the participation rates, or if there's a cap rate associated with it, that those are as applied for. In other words, at the time of application, if this product was offering 100% participation, then once the policy's issued, we want to verify that 100% participation was actually instilled in that contract and put out in that issued policy, so that it's as applied for. Otherwise, we have an issue and we got to send it back.
That's right. And that's just part of what we're going to review, is just to make sure everything is accurate to what we expected it to be within that policy.
So if you're looking here, we're using a specimen contract on an indexed annuity. This happens to be from Equitrust Life Insurance Company. This is a 1-year point-to-point participation rate. So when you're going through the issued policy, your advisor should be looking at these specifications. It's going to show the premium allocation, the amount, the initial participation rates. If there's a guaranteed minimum participation rate, that'll be listed there as well. What specific index is being used, and so on and so forth. So it's really important that you have someone that can help you understand what you're looking at. These contracts can seem at times complex. I mean, this one we're looking at here is 67 pages. Most of it's just legalese and like terms and conditions and definitions. So it's nothing to be super overwhelmed by, but you should be working with an expert to help you disseminate exactly what it is that you're looking at, and being able to, make sure all the I's were dotted and the T's were crossed as originally applied for.
Bingo.
What else we got there, Zach?
Yeah. Next, I mean, just sticking within the community of fixed index annuities, we would also consider any fees that may come with that. And most commonly, we don't see fees a lot unless it's correlated to an income rider fee. Maybe there's a participation enhancement fee, but really we're looking to define those fees and if there's a rider fee. So something like an income rider or maybe even an enhanced death benefit rider. There can be a cost associated with one of these policies. We just want to make sure we clearly define it. Again, making sure that matches up with what the expectations are at the application.
Yeah, we'll be going through an example specimen contract for an income rider specification page. So regardless of whatever rider it is that you may be electing to add to your contract, there's going to be a rider data specification page that will define all of the terms and conditions and the qualifiers, the cost, so on and so forth, so that you exactly understand. And what we also can show, Zach, is that like a enhanced income benefit for long-term care and that rider, and show the language around, how the person can qualify for that benefit. It'll explain and lay all that out so that you know exactly how it works and what is needed in order to activate that specific feature or rider.
Yeah.
Also, don't forget about, looking at these surrender schedules too, right? Like annuities are commonly associated with having a surrender schedule. Not that it's like a end all be all deal breaker that they have them, but you need to be aware of what those schedules are. And maybe it was different. Like maybe when you applied, the surrender schedule was less than what was issued. So you definitely still want to look at that. While in my experience, I've never seen one that was ever off. It is still possible. I mean, these insurance companies and our annuity providers, they can make mistakes at times, but that's what we're here for. As an advisor, we're here to ensure that, what you wanted and what you applied for is actually what you got. And that's our commitment, 100%.
Yeah, and really what we're trying to do is just double and triple check the work that we did. If we look at this, a lot of these carriers have several different annuity types. So for example, if we look at a fixed index annuity, they might have 5 different products that are fixed index annuities. So again, it's just making sure that we've gone through the process of being confident that we do have the right product selected and making sure it's living up to the expectations.
Yeah, for sure. I think that makes a lot of sense too. And it comes down to just ensuring that you got what you wanted. It's as simple as that. I can't tell you how many times I've actually heard, and this is what's kind of crazy to me, and how we developed our annuity assurance process is I've actually had people come to me before, Zach, that had bought an annuity fairly recently. After they purchased that annuity, the advisor that wrote that deal was nowhere to be found, would not review it with them. They tried to call, nothing. Or I actually had a scenario where a client was wanting to ensure that they got the right policy, and the advisor tried to act like they were so super busy and they couldn't tend to that client after the policy was issued to review it. And there was, I actually lended out our service to review that with them, just to help them out, because I believe that that was the right thing to do in that case. And we actually did find that there was an issue with the policy, the contract that was issued, that it wasn't issued as applied for. And it was actually really tough. What ended up happening is because the advisor was pushing this lady off in terms of setting up a time to review it with her, she actually became outside of her free look period, which we'll cover
Mhm.
in just a moment of what that means. But her right to inspect the policy was she was outside of that time frame. And when we found that she had the policy wasn't issued as applied for, actually what happened was there was supposed to be a rider, an income rider on there, and there wasn't. And the advisor made the mistake. It wasn't the insurance company. But long story short, after telling the carrier what happened, they sided with us and they trusted what we were telling them, and what the client's testimony was there. And they ended up honoring the free look of that policy. And she came to work with us, and we took her through that annuity assurance process, explained exactly how to compare the products side by side. And we actually ended up finding out that the one that she was that was put in place for her by the other advisor wasn't actually the best one for her circumstances. So it was kind of a blessing in disguise, if you will. While albeit a frustrating experience on her end, she ended up benefiting from it immensely, and she avoided a costly mistake.
Yeah, and I don't want to say we see that exact situation a lot, but we do find many situations where there can be a better result. And it's largely just an understanding what the individual's need is.
Yeah, for sure. Let's go ahead and take the time here, if you think that'd be appropriate, Zach, to look at some of the income rider specification pages from some of the products we have specimen contracts on. Do you think that would be good time spent?
Yeah. The
All right.
and it's a designated page, right? So when we look at these policies, again, like to your point, a lot of them are going to be close to 70 pages in length. This is a big glaring one that, quite frankly, I think in most of these policies is towards the back end of the actual policy booklet. So not jumping out at you. And part of what I do for the clients is I'll leave a little sticky note or I'll highlight something so that when we do go over these policy reviews, these pages are jumping out at them a little bit more than what they might in a 70-page booklet.
Exactly. So if you're looking at a product like an indexed annuity with a guaranteed lifetime income rider, you're going to have the rider data pages, or sometimes they're referred to as a specification page. And it's going to have all of the pertinent information regarding that income rider contract and how that income rider benefit grows during the deferral phase, how long you can defer that income benefit for, so that you can maximize on the growth of that income benefit base value. It'll also include the cost of the rider, so on and so forth. Sometimes income riders can be customized or uh, changed in a way that it can have influence on from the indexing. So sometimes you can have increasing income, you can have inflation adjusted income on some products. So depending on which one it is, all of those details will be in that rider specification page, which will then show you that you got exactly what you applied for. So this is an example from our friends over at Athene Annuity. So here you'll see listed the contract number, the rider effective date, the annuitant's issue age, the initial income benefit base amount. If there was a bonus on that product, it would include the bonus for that income benefit here. It will also include the benefit base interest rate or roll up rate, which is commonly the term used there. It'll show the roll up rate and how long that roll up rate is guaranteed for. In this case, this product had a roll up rate. It has a total roll up period of 20 years. So you could defer it out a max of 20 years if you wanted to. And in this case, they're breaking it down in years 1 to 10. The roll up rate would be X. Years 11 through 15, it would be X, and then 16 through 18, so on and so forth. So all of that stuff's going to be in there, including the rider charge. Sometimes the riders can have a max rate. So they might have like a lower interest rate, or I'm sorry, rider rate starting out, but they might have also a max that they could potentially increase it to. We're not big advocates, and anybody that has the ability to increase the rate, So most of the products that we would try to identify based on the situation are going to have fixed rates for the rider cost for the life of the policy. I think that's important. But if it was a product that did have the ability to increase that rate, it would be listed there what the max is that they could charge.
Part of the reason that we're going through this exercise is just to show you, number one, these rider pages we're going to see from a couple different carriers. Same general information, maybe laid out a little bit differently, but we want to share that this is in every policy you're going to look at. So this will be a part of it, provided you've gotten exactly what you're asking for.
And the most important part of the contract, in my opinion, is going to be what's called the certificate of disclosure. Sometimes it's also called an SOU, a statement of understanding. But here's an example of that certificate of disclosure. It will be in the application, and it also will be in the issued policy. But what I like about it is this is the true legally binding information. It defines everything that you should know about what you're applying for. And it also answers the most frequently asked questions, such as, how will interest be credited to my contract? What if I decide I do not want my annuity contract after it is delivered? It will allude to that free look period. What is the minimum interest credit rate? Does my contract have a bonus? So on and so forth. What are the free withdrawals in my contract? What is a confined care waiver? What is a terminal illness waiver? What is my surrender charge schedule? So that's where you're going to find all the meat and potatoes of all of these different features and things that you should understand and be aware of. Are there tax consequences if I withdraw from my annuity? Like all of those things are going to be outlined. What is the death benefit? What is the Athene Ascent income rider? What is the cost of the rider? So on and so forth. What is the income base? So I highly advise whoever you're working with, to make sure that they're covering that disclosure or the statement of understanding, depending on the product you're looking at. Here's an example. If you're watching this at home on YouTube, we're sharing our screen right now, and we're looking at now another example of a specification page for a income rider that's offered by Nationwide on their High Point 365 Select fixed indexed annuity. Theirs is a bit simpler, in my opinion. You're going to have that rider effective date, the covered life, which is the annuitant, and if it's a joint covered life or joint annuitant, it would have the name listed there. Both of their dates of birth, the minimum deferral period. So if there's a waiting period that you must wait before you can activate the income rider, that would be stated there. Sometimes these indexed annuities will have a 1-year wait time. Others you can activate immediately, so you don't have to wait. What that rider charge is, all of those things are going to be listed there. And then what I also really advise you to be aware of and making sure that you match up what was illustrated and applied and issued as applied for is what I call the payout percentage. Part of the formula of determining the income payment, the lifetime income payment, is the income benefit base value multiplied by the lifetime payout percentage. And in the payout percentage table that's in this contract, it's going to outline the exact percentage based on the number of completed contract years. And it will default, if it's joint life, to show the percentage based on the youngest of the two annuitants' lives that are covered. But you want to make sure that this payout percentage matches what it was illustrated as. Sometimes those payout percentages can change depending on the interest rate environment that we're in. Sometimes these contracts can take a little while to get funded and things, depending on the situation. Maybe you just recently retired and your employer says you have to wait 45 to 60 days before you can access the funds. I mean, sometimes that's reality. And all we want to make sure is that once the annuity contract is issued, that you're getting all of these detailed data points issued as applied for. Another example here of a rider data page. This is from our friends at Corebridge or AIG, Corebridge's AIG's annuity arm, they lay it out very simply, rider effective date, who the covered persons are, eligible premiums, what the rider fee is, the income credit percentage, which would be the deferral credit for the roll-up rate, income crediting period, and then here's their payout schedule, whether it's one person covered or two covered persons, and then what age they fall into at the time of income election. That would determine the percentage. So they're all going to be fairly similar. Here's one from Emeritus. Let's see if I can find their income page. But you definitely want to make sure that you're taking a look at these and not just basing everything on trust alone. So here's their page. Again, covered persons, the rider charge. Here's an example of a max. They can increase that rider. Not a big fan of that. Not all companies do that. So be aware of it. What the roll-up rates are and how long they're guaranteed for, so on and so forth. What am I missing, Zach?
I think you nailed it when it comes to the income. With these fixed index annuities, some of them do have additional features that they may come with. We've talked about surrender period, what that looks like. We've talked about the ability to withdraw, how much withdrawal amount we have. We have noticed that with some fixed index annuity policies, we've got a feature like an enhancement. And maybe that's an enhancement feature allows the income to increase for a set period of time. Should you have the availability to use that feature, and that's for the purpose of care.
Yeah, let me pull that up here. That's a good call out. So here's Athene's example of a product with an enhanced income benefit rider. In most cases, the enhanced income benefit rider is included in the lifetime income rider. So there's no additional cost for this particular rider, but all of the details of how that benefit can be triggered are laid out here in easy to digest and understand terms. So with most enhanced income benefit riders, the main qualifier is going to be that you're unable to perform 2 out of 6 activities of daily living. Those are things like bathing, dressing, eating, toileting, transferring, incontinence. So if you're unable to perform 2 out of 6 of those, and you have an attending physician statement that discloses that you're unable to perform 2 out of those 6 activities of daily living, and you're qualified to a facility, or maybe it's nurse in-home care, then you need to be unable to perform those 2 out of 6 for a period of 90 days consecutively in most cases. But this is an example showing them what the qualifying conditions are, how they're triggered, and then what will happen if you qualify. So in most of these, there's going to be an initial waiting period. So you can't just already be in a nursing home or in that state of needing enhanced care. You have to, so that's why they have a waiting period. So this one in this case is 1 contract year. And then if you do qualify, the income benefit multiplier. So how these will typically work is that whatever the guaranteed lifetime income payment is, it will double or multiply that guaranteed amount by 2 times, and it'll pay that doubled amount for up to 5 years. So you'll see the income benefit limit here is designated as 60 months. So they go into defining all of the other terms, like what is a qualified care facility, more details on the activities of daily living, so on and so forth. So it's pretty easy there, but that's a good call out. We should definitely have checked that out. So I'm glad that you mentioned that, Zach.
Yeah, and just as a note, by the way, just heads up, this doesn't mean that every policy that has an enhanced care benefit rider functions in the same capacity, right? So not every one of them is a qualifier of 2 out of 6 activities of daily living. Some may require that you're in a nursing home. So it is important to just understand exactly what comes with that.
We also have the specimen contract for a single premium immediate annuity. You think we should share that one here, Zach?
Yeah, so while we've touched on some of the more complex policies that are out there with fixed index annuities, and knowing that there's some length to these policies, it is important to know that, with a single premium immediate annuity or deferred income annuity, you can expect the same thing, and that it's going to provide you those specifications, and it will have a page that tells us exactly what it's going to do and more details around the definitions and other key components with waivers that come with it as well.
Yeah, the single premium immediate annuity is one of the oldest annuity types, and it is the oldest annuity type when it comes to income benefits and guaranteed income benefits. They're very simple contracts. It's the exchange of an initial premium investment for a guaranteed income stream. That income stream can be guaranteed for life, or it can be guaranteed for a period of time. It's customizable in that sense. But it's really as simple as that. You're giving up control, relinquishing control over the initial premium in exchange for an income payment, either for life or for a period of time. How it differs from the indexed annuity, which we were just reviewing, the indexed annuity, you do not relinquish control over the asset. You maintain control and actually have the ability to earn interest on that money throughout the life of the policy. And if you die, there's a death benefit, whatever's remaining in that account, et cetera. So here's an example specimen contract for a single premium immediate annuity. This is from Penn Mutual Life Insurance Company. So here it's very simple. The policy specifications, who the annuitant is, their date of birth, the policy number, and then they will actually lay out what the specific monthly annuity income is. And the reason for that is because in that type of contract, when you apply for that product, that's set in stone. You're going to indicate during that application process when you want that income to start, and that's in stone. So it'll right here, it's laying out first annuity date. That's when the income starts. So in this case, they're showing us March 28th, and the date of issue was on February 28th. So this is an example of someone activating income as soon as they can in a single premium immediate annuity, which is 30 days after the date of issue. They're showing here the description of the benefits. They describe it as life annuity. That means in this case that it's just a lifetime guarantee. There is no period certain or any type of installment or cash lump sum refund built into this product. It's just strictly a lifetime income payment. They're showing the initial premium, $150,000 in this example. And that's it. They're going to kind of have a few pages to show just the different terms or definitions of the terms. But that's it. It's very simple.
Yeah, straightforward. Just sort of like that policy itself, just the purpose of that annuity type, straightforward.
Absolutely. What else we have, dude?
The only other policy, I don't know if you wanted to use this one, was just the MYGA, the multi-year guaranteed annuity. Again, simplistic in its structure, and that a fixed rate annuity or multi-year guaranteed annuity provides a guaranteed rate for a set period of time. And the contractual guarantees do exactly that.
Yeah, so the MYGA is a very simple product as well, multi-year guaranteed annuity. It's also referred to as a fixed rate annuity. It's very closely compared to, at times, a bank certificate of deposit. It's a time deposit vehicle where, for an agreed amount of time of keeping your money in that contract, the issuing annuity provider will provide you a guaranteed interest rate on your money for all of that time you agreed to keep your money there. So in these contracts, this is another example from our friends at Athene. It will include your contract number. There is still an annuitant in this type of annuity, even though they're not commonly used for income. Why the annuitant is still required here is for two reasons. If the person dies, if the annuitant dies, that then activates the death benefit payout. Okay, so has to still be based on someone's life. In addition to that, all annuities, regardless of the specific type, can be converted to an income stream through what's called annuitization. And annuitization is based on the annuitant's age at the time of activation. Now, less than 4% of annuity contracts are ever annuitized. If somebody's looking for buying income or converting to lifetime income or a period of income, they're going to be best served by buying an annuity that's specifically designed for that purpose. It probably wouldn't be very prudent to annuitize a MIGA, since that is not their strong suit. That they're not designed for that. It'll have the issue date, the initial premium, what the minimum and maximum premiums could have been. If you can add additional, it'll specify how much you can add up to and how often you can add it, or the max length of time you can add it. And then there will be the withdrawal charge schedule as normally commonly associated with annuities as a surrender schedule. It'll have that broken down. If there's a free withdrawal percentage allowed per year, it'll have that defined as well. And then here's where it'll showcase the fixed strategy data page, which will show the term period that the initial guarantees are in place for, and then what the interest rate is for that agreed amount of time. Pretty simple.
Yep. And part of the reason why we're sharing this is, in our process, this is one step that we take with our clients. And we want to be transparent. We've talked this to death, I'm sure, but ultimately our goal, and part of the reason for founding this company, like Jeremiah did, and with our co-founder, Steve, was just that we really wanted to bring something to the table that's currently just not out there. It's also part of what we're doing here in the podcast, just bringing the information up front for you to consume it and take it in on your own.
Yeah, I couldn't have said that better myself, man. It was really about trying to do the right thing. That was the founding principle of our company. And that was, hey, these are great products for people. There's good ones and there's bad ones, just like anything else out there. And people need a better way to assess what is available, learn how to compare and contrast the available options, what they should be looking for, and then tying in, their needs and how that product can fit those needs and help them ultimately near and long term. And what we found was there was no real way for any consumer to compare all of the annuities on the marketplace in one centralized location. Typically the traditional approach is that they have to go to different advisors, and then all of those advisors, most of the time, they only have a couple annuities that they're profound in. And, that's not the best approach. So what we did is we formulated this annuity assurance process, and that includes our multi-point annuity inspection. And by design, that is to help people make better annuity buying decisions. We do that through education and transparency, to help you make your own decision. And in doing so, we hope that we can earn that trust and earn your business ultimately. And that is how we make our living. So part of that multi-point inspection, Zach, do you want to cover those points real quick, and then we can wrap this thing up?
Yeah. So part of that multi-point inspection is looking for, if we're focused on an income, right, and what that annuity's purpose is for, that might be the highest income guarantee or highest rate of return. The carrier strength, that company that we're selecting, is that important to somebody in that decision-making process? Index crediting potential, how these fixed index annuities can credit. In addition, that would be the rider fee. So we also consider that fee, like Jeremiah had hit on before. We're not prone to leaning into a company whose rider fee can change or increase over time. And we had also briefly talked about the enhancement for income and long-term care. Is that a factor in your consideration of selecting an annuity? And if so, then we can factor that into the equation. But that's how we're getting to that point. We're using that multi-point annuity inspection to find the right product for our clients. And then we take it a step further from there once we get into actually moving forward with an application.
Yep, that's the truth. I was trying to find that cool little visual that we had put together with the board, like the checkboard. For that point, I couldn't find it. I have to figure out what I did with it. But But yeah, so that's really it. I think the other thing too, as a parting thought here and a takeaway, is that in order to ultimately avoid mistakes, right, you need to make sure you're working with a professional, someone that truly cares and acts in your best interest, which they are legally bound to do. But not, what we find is that there's some gray area there, and not everybody does that. In addition, maybe you've already recently bought an annuity and you're kind of having some doubt. Maybe your intuition's right there. You need to know that in all annuity contracts, you have a free look period and the right to inspect. So, depending on the state that you reside in and where that policy was issued, there is a mandatory free look period that can be anywhere from 10 to 30 days, where you can cancel the contract after receiving it and receive a full refund for any reason. It doesn't have to necessarily be around that, the carrier or the advisor made a mistake or there wasn't something in there that you hoped for or applied for. It can be any reason at all. So just know that even if you did something as a spur of the moment kind of gut response or knee jerk reaction to something, that if you did, you still have the right to inspect it. And if you want, you still can free look or return that policy in exchange for a full refund.
Right.
Um,
Yeah. So you've got that window of time really that we can free look that. Um, and then to your point, once we elapse that surrender period, I'm sorry, once you elapse that free look period, now enters that surrender period.
yeah. So our advice is definitely to inspect your contract immediately upon delivery. Make sure it aligns with your goals. And if something's off, call your agent or advisor or even the insurance company before it's too late.
Yeah, real quick, I just had a client recently who ran into that. They were working with a premier company, happened to be a newer agent. He had provided the expectation of roughly $1,200 a month for the income guarantee. Come to find out, when they had funded the annuity and moved forward with it, gotten a copy of their policy and logged into their account online, the income amount guarantee was $800 a month. And she said,
Oh, wow.
something's not right here. So contacted that advisor and found out that the way he illustrated it was also factoring in dividends, which would not be a guarantee, but potential. So in considering that, she said, this just isn't a right fit because this wasn't an honest and transparent process. So she had approached us and working with her now to find out if we can provide some value in another annuity. It sounds like we're there, but I've got some more discovery to do to make sure we're fitting her in the right policy.
Well, thanks for sharing. And one thing I can say there, Zach, is that not all heroes wear capes, my friend.
There it is.
That's
Amen.
huge. That's huge. So thank you for taking care of the client and doing the right thing there and helping them make a better annuity buying decision. So final thoughts here and takeaways. At the end of the day, your annuity contract is a promise on paper. It's literally a promise on paper. It's what protects your retirement income or preserves your retirement egg, right, Zach? Retirement egg.
A
It's what
retirement egg.
preserves
Yes.
your retirement egg for a decade.
Yeah, and ultimately, just as a reminder, if you're not sitting down with your advisor to look this over and look over the policy, ask them to. And if you want a second opinion, or if you want somebody else to sit down and look at this with you, we're happy to. So take a look at it. This is important. You're not just putting all this money into something for hope. You need to make sure that these are guarantees. You know exactly what these guarantees will do for you.
For sure. So, yeah, if you're interested in doing that, you know where to go. In the show notes here or the description of this podcast episode, there will be a unique link to schedule your free annuity discovery meeting with one of our subject matter experts like Zach. Or you can, if you're maybe not ready to meet just yet, but you want to get more information on annuities and get a report that's tailored and customized to your specific situation, there will be a second link there where you can request that free report. But either way, whichever you choose, we appreciate the opportunity to serve you and ultimately help you make better annuity buying decisions. This is Jeremiah Conjure
And Zachary Van Ness,
the Annuity Dudes, signing off. Thanks so much. Like,
see you.
share, hit the bell, all that fancy jazz. We appreciate you so much. Thank you.
no-fluff.